None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Monday morning again. Seems like they just kind of come really quick anymore. Lots to go over today, as many of you got the emails and subscribers and other folks that are on board. We had a massive amount of sales and exits on for Friday's run, and Mitch and I talked about that on Friday. That we thought we'd have a lot. It was a little surprising when I saw the run on Friday night. It was like 70, I think 7803 was the net.
7803, yeah, on a weekly. Yeah, it's just crazy.
Yeah, so as we said, this is one of the largest number of sales that we've had since back in the Lehman days in '08. So that doesn't necessarily mean that the Lehman days are back, but it certainly would tell you that there's something significant going. And I talked about this over the last couple of shows, is that we continue to see all of these trades be very sensitive, and they should be sensitive, I think. You know, we're sitting here, just last week we were printing, you know, the historical highs, and right now we're off maybe 3% off the high, something like that. So is it a lot off the high? No. Yeah. The fact that these things triggered, though, I went through as many of these things until I couldn't click anymore on Saturday, and it was there were a lot of patterns that have broken down that were pretty significant from the standpoint of you know, just the general, I guess, view that I kept seeing there was, you know, really just these massive amount of sells, and the patterns were very similar. They were all breaking through their 40-period moving average on a weekly, which is very similar to a 200-day moving average. So we've seen a substantial breakdown of the trends. And when these things happen, those who've been around us for years, you'll know that when we see these massive amount of sells, what it means, it doesn't mean the end of the world. What it does mean is that there has been, I think I figured out I wrote this number down somewhere. Of course, I don't have it right now. It's 10,280 symbols that are neutral right now. We have no trend. Some of those are in downtrend, some are just neutral, some are just going sideways. And what that tells us is the probabilities of the markets going into and continuing this trend is becoming zero. Now, I saw on CNBC that Jeremy Siegel says the bull's not over, so we know it is. You know, whenever the professors are out talking about the markets, you know, I've never met a professor who could trade the market yet. We beat the heck out of what's his name a few weeks ago. I'm trying to remember.
And I'm blanking his name.
Yeah,
it's probably just as well. Poor
he's
guy.
got the mutual funds. Yeah, I'm trying to think what it is. Well, we'll think about it. But anyway, you know, it's just professors should stay in classrooms. We used to have the smart people show up on the trading floors. We just take all their money. They were lucky if they lasted a year most of the time. And there's a lot more to these markets. As I mentioned on Friday, that the sentiment is the emotions that are behind this market. And there were a lot of emotions. On Thursday was the key breakdown in this pattern, and it was the end of the month. And I talked about this on Friday's broadcast, but it was the end of the month on Thursday, and we saw it go from literally from the highs to the lows of the bar for the month and close at the low. Fortunately, there's a number that 1915.98 was June's low. That's really important, that number. We were down to 21 today. We were at 1637, so 1637 on Friday was the low. We came within, 50 cents of breaking that low. Had we broken that, we would have had an outside reversal. As it turned out, we had a reversal, a downward reversal, and I'll go through some of these. I went through some of the past major events that have happened on the monthly graphs to kind of give you some perspective. And from our viewpoint, when you get all of these patterns breaking down like we've seen, it's not just 7,800, because I don't know, maybe Mitch, he can look at this while we're talking, but maybe a cumulative, bring up the sheet to see what the cumulative over the last 6 weeks. We've been net sellers. We've been moving things to cash gradually, and then this morning, I suspect most of you were quite busy putting orders in over the weekend in that. And the representation of our group is probably billions of dollars of securities were liquidated. I love the fact that we had an uptick for the liquidation orders. I wish it was actually a little stronger than it was. We're trying to fade back right now. We're up 50 cents on a day. Actually, it's bouncing around between 50 and 90. But the bottom line is, these are nice stable markets to sell into. Most of what's happening, for the most part, probably about 60% of these trades are actually taking profits at some level, whether they're just tiny profits. Some of them are still things that are rolling out from 2013 that we saw, because a lot of mutual funds, and Mitch is going to go through, as always, go through some of the funds. So the format that we always do is we're going to because of the magnitude of what's happening in the markets from our viewpoint, we're going to spend a little bit more time, probably the first half hour, on just discussing markets, the technicals, and then Mitch will go through and talk about the actual rotation in the database and go through the VPM dashboard, so you can see a lot of transparency that went on around the planet as well as here domestically. So I'll go ahead. I'll use that as my cue to go ahead and bring up the charts. And Mitch didn't have much to say. That's why I took him off screen. Just joking.
Yeah, it got me out of there. I was going to say that over the last 4 weeks, we've had net liquidation of 9,639 symbols. So when all is said and done, over the last 4 weeks, we've had that many sells. So that's pretty substantial.
It's more than half of the database. And by the way, I brought us both back on screen real quick here. By the way, not everything acts and looks like a crisis when it's not a crisis. But what does happen, for instance, what I'm saying here is when we did have these big sell orders in '08, these were related directly to a lot of the failures that were happening in the marketplace. And then we had systemic risk come in as the banking system came under more pressure, as Lehman did fail, and some of the other events around that September-October period of 2008. We are not there today by any means, okay? What we are at is a point where I've been talking about several weeks now that this trend is coming to a very climactic end of a 5-year rally, 5-year plus rally that it's one of the biggest rallies in the history of the market. So it's certainly going to end at some stage. Certainly doesn't start necessarily with a big giant cliff, but the risk that has come into the market is actually huge here. So you got anything, Mitch, before I take you off screen? We're going to
go ahead and get ready.
All right. So here's the thing. I think it's important. What we saw last week was a couple of things here, and I've got the weekly graph up, and we use TradeStation, and we have a new version of VPM Market Mind, which is my original software company. We're revising this and bringing it out. So most of the stuff you see is VPM MMs and all the indicators, which are the same PPMs that you have in VPM 2.0 or Expert or any of our other products. And so what we're doing here is seeing a massive decline, and we declined through the 10-period moving average down to the 21-period moving average. And one of the things that has happened, we were in trend mode across the board on the intermediate. We are now, I talk about this all the time when you're looking at trends, especially. I'll bring up the PPMs here. The PPMs. So we're looking at a couple values here. Is we've got PPM 1 is at 0.13, PPM 2 0.11, and 0.22. So the longer term average, the 40 period moving average, which is similar to the 200-day moving average, has actually still very close to trend mode yet. So that is going to be the key support. And typically what you'll get off this break, you'll get 2 to 3 weeks of a break down to support levels, and then a rebound to set up a right shoulder. And I'll go through some of these patterns that I located over the weekend. It was too much to try to write in commentary, so I decided I would do most of this stuff on a live show here. And actually, this venue that we have is really working out. Our traction is up to several hundred of you watching it right now, and it's getting our message out. It's giving the ability for us to discuss the markets at a very high level and keep everything, I guess, in front of you so that you understand what the thought process is from my viewpoint as an analyst, as well as what the software is telling us. And that gives us a lot of ability to go way, way beyond the old days of just commentary, and you can watch it anytime you want. But the bottom line is we've seen these 0.13, we'll call it 12, and 0.22. We are below the 0.25 trend mode, which tells us that this trend is now flattened out. It's not a collapse, but what it's going to do is we're going to go into a sideways range. If we get to 3 weeks down, this would be week 2 that we're working on right now. If we get this week down, the following week down, we should go down toward these moving averages. And there's a couple numbers down there, and I believe I put them in commentary. But you're going to get down around the 1884 with an extreme around the 1865 level. It's funny saying the 18 number. I get so used to saying 19. Now it's 18. But it's all going to be based on, at least for this week, taking out that 1915.98. We'll call it 1916. And that level's taken out. Then we're going to see this thing unfold. Probably the next 3 weeks, seeing us down. Could be as low, like I said, as 1865 would be an extreme. There's some other support just under 1800. 93 to 84 is a level that we could see. But for the most part, we should see 3 weeks down, and then we see a rebound, and that rebound should not go above 1956, actually, is the number right now. I'll update that as we see what pattern unfolds, but that's the estimated resistance point, or the possibility where the right shoulder will be formed, and then we'll start another leg down, which will be ultimately more substantial. And what happens, I've talked about this before, momentum, like we have the 0.22 on PPM 3, which is tied to the 40 period moving average on a weekly basis. That's telling us there's enough there that the market, there's only about a 30% probability at the moment for the market to decline below that value of that moving average. And one of the keys of using moving averages is what I developed way back in the mid 80s. What it is understanding what the level, the PPM stand for price pressure momentum. So the price pressure momentum at 0.25, once it reaches that, it has to maintain over 0.15 to remain at least in a minimum trend mode. And once it breaks down, like what we saw on PPM 1 and 2, then the short-term rates have broken down. But what it tells us, it gives us a probability of the value of that moving average and the validity of its support number. And we've done, and we'll start these back up after the summer. If you notice, we started the show started with summertime blues, and the blues are maybe getting a little bit over, so it's not so much the doldrums after last week. At least they woke up, all of us, and to pay attention here in August. But the bottom line is what we're seeing in these trends is they are starting to roll over, and we're starting to see where these things are going to start to consolidate. And the basic philosophy that I've had for many years. I hate to admit that I've been doing this for 35 years. Last Saturday was my birthday, so I keep remembering that I'm no longer a young man. I've been doing this for a long time. But one of the key elements that continues to pop out is that understanding that if you have a stock or a symbol that is not trending, and why would you own it? Okay, I would rather be in cash, not taking risk with a symbol that may go up or may go down. I would rather have all the probabilities slanted for me, and that's why 10,280 some stocks are in neutral phase right now. Doesn't necessarily mean they're going down, it just means they're not going up and they're not in a trend mode. So I would rather, we are trend followers for the most part. We look at pattern recognition as well as trend and momentum. And when you're using those type of elements to guide your investments, then you have to understand that when they don't exist, you're much better being in cash. There's not much to miss after, I don't know what the percentage of the gains are from the lows, but we were at 600, so it's, what is it, almost 180%, or I don't know Mitch, do you know what we are off the lows? Can you figure that up?
I'll do
divide
the back 660.
Of the napkin take 660 and divide it by the current price and give you an idea of the high.
189%.
189%. So we're up 189% since the lows of 2009. So, if it was an individual stock, we'd probably be pretty excited. We're talking about an index here. We're talking about 500 stocks being up that much. So the bottom line is this thing has been very robust, and it has definitely been trending, and I've talked about that this is the final leg of this particular sequence of the market. And so there's some scary things. I think I still have some charts I brought up on Friday, but just moving on is this is the scenario that's likely to unfold: 3 weeks down, 2 up, and then 3 to 5 down after that. So that's going to put us into September, maybe early October. And while October has this history of being a big down month, it's actually the month that the market has bottomed more than it has collapsed. Even in 1987, when the market collapsed, October was the low of that move. It may have happened in, I think it was October 17th or 19th of 87, the decline may have happened there, but it also ended there. So a lot of times people are looking at the seasonals. And it's interesting because August has a tendency to be a fairly good month, but when it goes really bad, it goes real bad. It can be 6-8% declines in the bad August. But for the most part, I think it has more of a probability of being an up market. So you got Dennis Gartman, Siegel, all these guys still liking the market, telling you to slow down, buy the dips. Maybe we'll see. But I don't think even if you buy the dips, you're not going to see this trend turn back up on the upside. So let's go and look at a couple of charts that we normally look at on Monday mornings, and let's go over. And this was interesting. It was quite awakening. If you watched Friday's show, which a lot of you did, we saw the momentum on the 10-period moving average drop below 1%, and I was anxious to see what it was going to look like when we got a tick for the new monthly graph, which we got this morning. It's popped back over 1%. That's 136. It is still advancing pretty strong there, and that tells me that's going to be a similar number. Just going to find it's 1879.38. So there is a cluster of moving averages between we'll call it 1890.93 all the way down to 1865. That is very substantial support. But what will happen after we spend weeks moving down into those areas, the momentum will start to be lost, and we'll be able to see some of those things going on. I'm going to just go full screen here on analysis so you can see some of these other things here. But so the monthly, which I often refer to as the super slow-mo, is actually still in trend mode. It's still, long-term trends are still in place, but now we're looking at the support levels are down below the market, just under 1900. So there's still a lot of work to be done before any major decline is going to happen. And like I said, the fact that we had 7,803 exits, and what was the total again, Mitch, on the
for the week or for the month?
For the last month, it was like 10,000.
Yeah, 9,639 symbols.
I'm gonna write that down. So 9,000 what?
9,639.
There you go. Okay, got too many numbers in my head. So yeah, so
you're doing pretty good keeping the other stuff there.
Oh no, I know, of course, but the bottom line is that this market's not in a collapse mode. This is not 2008, and it's probably not 2011. They keep trying to revive that, and we didn't mention in our little commentary that we were talking about earlier is we didn't mention the fact that was it Banco? We were trying to pronounce it. Neither
Banco,
one of us.
Espirito. Oh, geez, I just had it too. Santo.
Yeah, Santo.
I never took Spanish in high school, so I can't be held responsible for that butchering.
It's very obvious. So anyway, but the bottom line is what they bailed the bank out, and I mentioned this on Friday that it's going to be important to see how the European community handles this. Well, they kept the status quo. You bail them out, you go forward. So that scenario's happened. So that's taken some risk off. Last night when I was doing commentary and researching the markets prior to the European Open, the futures were printing up about 700 to 800 at the time. It looked like we were going to have a nice strong opening, and I figured by the time the Europeans got done and sorted through everything that we wouldn't have nearly that type of opening that we were expecting. We did see a little firmer to flat to firmer when we started, but it's just kind of just waffling along right now. And this week has not got a lot of news with it. The news that's out there is sort of, yeah, so what kind of news? Maybe jobless claims or something on Thursday people will key on, but there's not a lot to drive the market. So what's going to drive the market this week is market sentiment. My bet is, just looking at what happened, is that market sentiment's changed a lot from 2 weeks ago. Last week changed, and Mitch and I were talking about that. Bring Mitch back on because help me with this conversation. But we were talking about how we had all of these wonderful things: GDP at 4%, all these great numbers, real estate, everything, and market participants went, so what? They did more than so what? They sold. Like get me out kind of orders came in on Thursday. That was a big day when the way that traded. Those are the kind of trades that you see that when you see those things. And I remember days on the trading floor and you see this. It's impactful. It lasts. There's a lasting memory in market participants and how those things traded at that time. So.
Right. Yeah, one of the things that I mentioned on Friday, I think after our broadcast, just between the two of us, was that it was interesting. Once you account for all the good news that came out, and you look at all the possible bad news that could have had effect to the markets, really nothing had changed. I mean, we had the default when it came to Argentina, but there really wasn't much market exposure there. And you look at all the other factors when it comes to the geopolitical aspects, nothing had really changed. And really what had changed was the fact that we had this good news. And so the only thing that you could account for that, is that classic Occam's razor theory. The simplest answer is probably the right answer. People just didn't want to hold on to the market anymore. They took their gains and they ran.
We're going to have a whole show on that theory, I think. You brought it up twice. Anyway, I'm joking. But what's happening, you can see I brought up the daily chart here. And the daily chart, you can see the breakdown clearly. And here's important to understand on the short-term trends, and this is why we're not going anywhere right now on the upside, is you've got PPM1 at minus 0.26, which is trend mode to the downside, minus 12 and flat on the 40-period moving average. But I've talked about this whole moving average thing. When you take 2 or 3 moving averages together, ultimately what happens when the trend changes, the shortest moving average or the fastest moving average is going to penetrate through the other averages, even on the upside or the downside. In this case, it's penetrating on the downside. We're really close to penetrating the 10-period moving through the 40. And the interesting thing on this, while it sounds like, a negative event, about 70% of the time, that's where the little bounce happens from. There'll be a little bounce when that happens. Looks like the collision course is for tomorrow for that to happen. So we could get a little intraday low. And like I said, that all the bets we've moved up $4 on the day here as we're talking. So we're continuing to see some stabilization. Real quick, just to kind of get through the indexes here, bringing up my magical 24-hour futures charts that I usually like to go through. There was a cycle that came in this morning, spot on where this bounce came from. It looks like we should rally for about, I'm trying to remember what this cycle is. So it's 66 period cycle. So we're talking 3.5 hours. So as we come in, interesting enough, toward the last hour of trade, guess what? We're going to be hitting a cycle high if we stay positive. We'll probably see it retrace back in there. The call on Friday that when I looked at this, I thought we could see a rebound. When we did the show on Friday, we did rebound into the close. We actually got unchanged. May have even printed up just for a touch, but it didn't stay there, and we ended up down 5 as they faded them into the close. Suspect the same thing, and there's another element, old trading floor experiences. A lot of times when you see the last hour selling, there's two things happening on institutional selling. Some of it prompted through liquidation of mutual funds and things of that sort, where they're trying to rebalance those funds at the end of the day, depending on how much was sold. And so you'll see some institutional selling there. Also, it tends to be that the last things that the European and the international folks do is put the sell orders in the last hour to go out of the markets, depending on what they're doing. So so this chart here suggests that's the case. So 5-minute graph sets that up. The hourly graph also came on with, there was a volume cluster earlier, but we're still a ways off for this. It looks like we could be into maybe a couple hours of the evening before. So toward the end of the day, if we do continue up, then we could be seeing a little bit of a print to the upside. On commentary last night, the key trigger number is 1919.50. We've had a low today of 19, where is it at? 1921 and change. And so we did not take out that low, so we still have a bias for a positive trade for today. And it's pretty typical after a big day, you get what I call the dead cat bounce, but it's also an inside session. So you don't make a new low from Friday's session, which would be below the 1637. And then the other side would, so if that holds and we close higher, then that's pretty typical. You'll get a little bit of a rally. I was talking about maybe a rally this week toward 1937 to the 1943 area, and then another retest of low. So Friday's low isn't done yet, I don't believe. So that's kind of the synopsis of that. Let me show you the international spreads, and this was something that I've been talking about for a while. So EFA versus the S&P since 2009, you've got a very positive for the S&P, negative for the Europeans, and I've been talking about this thing for probably 2 months now. I've been bringing it up. We're starting to see a little turn here. We've seen these little jig-jags in the market before, but this I'm watching very closely to see if it breaks the trend to the downside. And this is versus the EFA, so it's kind of flattened off a little bit today. It was a big move, even though we were down big the other day. Europe wasn't down as big, and supposedly on Thursday that was supposed to be the reason why it was happening, right, Mitch?
Right, that's right.
Well, I'm just going on and on, so I want to get Mitch on. We're going to bring up VPM. I'm going to fade in the background here for a minute, and what we want to do is go through the dashboard and get that going. I'll get it going for you there, Mitch. And so there's
Excellent.
a lot to talk about, actually.
There is. Yeah,
I'm going to give it to
jump back over to 2.0. Just want to start off there because for those that aren't familiar with these dashboard or the dashboard that we created, the whole point of this was to provide a little bit better context when we talk about the order activity that's coming out of the system. So for a long time, really for ages, I'll say. We've had this data in the database. It just hasn't been necessarily the easiest to find, and a lot of people didn't know where to find it. So when we talk about the weekly runs, if you go over to research, it'll take you to the weekly research page, and then you click on all stats, it'll tell you what the weekly order run was. So one of the first things that Bob and I both do late Friday night, early Saturday morning is we come in here and we take a look and see, well, what type of activity is taking place within the database. And as you see here within the system, here's where we're getting the numbers that we talked about here. As far as the current entries, we had 91 and 146 between the two weekly 1.2 and 3.2 systems. So those are brand new buys. But here are all the exits, the 4,016 and then the 3,976, which brought us to that net trade of selling of 7,803 securities. And so that's the overall run that we're talking about. What we did with this dashboard is we took a look at all the securities within the database, all 18,000 securities, and we're looking at the sectors and the groupings that these securities are part of to be able to provide a little bit more intelligence, some more information as opposed to just raw data from the system. And interestingly enough, when you look at the stock side of things, we pretty much had consistent selling across the board in the double-digit range. Last week we had, or going into this Monday's entrance, we had a net move of 14% on the selling and on financials, and then a 15% selling in utilities. So even though there was a lot of news items last week when it came to the financial space, one of the things we talked about on Friday was actually the utilities and the energy areas that we were seeing probably the largest pullback, between 10 and 15%.
Yeah, real quick, I had a comment on that, is that the utilities, and we started developing a theme on Friday, and we're going to continue that theme through the shows this week. And by the way, should there be any more excitement, we may end up doing a Wednesday show, so we'll be notifying you if the markets are getting crazy again. But one of the things that what we're starting to develop is that we're seeing some cracks in the armor from the standpoint of the high yield and the corporate bonds, and that would, anything that's yield sensitive. Even though the treasuries moved down last week, there seemed to be an awful lot of action, I guess, on the other side on some of these other securities. So I just wanted to insert that real quick.
Yeah. So actually, let's jump over to the fund side, because this is probably the clearer view of the database.
Yeah, each one of these tabs that you see up top, you can click there. Mitch is clicking on, and you can see, I guess, call them best of breeds of funds in each one of these sectors, right?
Right. Yeah. So what I tried to do is I tried to filter the list down to, in the case of mutual funds, the A shares or the institutional shares, as opposed to having all the different share classes in there, to get a really good quality view of these areas. But you can see here, when it comes to U.S. equity funds, we had sales in total of 35%. So if we click here on the U.S. equity funds, we can see all those sales broken down by the actual investment categories for each of these. So you see here, not too surprisingly, the small cap space and the mid cap space had the largest movement. And we've been talking about all year about how the Russell 2000 especially has just been getting hammered. And you look at it, and, of the major indices that people are talking about, that one is down the most year to date. And you can see here that we had 46% selling on the small blend, 37% selling on the small growth, and the largest of all of these was the 49% sale in the small value. So the small and the mid cap had a massive move out of those equities. So if you have these types of securities within your portfolios, undoubtedly you saw sales this week of those type of assets. In our global equity 4 strategy, we had some orders this week, and unsurprisingly, it was that small cap and mid cap space, those blend ETFs.
Yeah, show them a little bit of the fund detail just quickly, because when you click on these, you can drill down. If you click on any of these, like small growth, any of those, I guess doesn't matter. But if you click on those, you can actually drill down into the funds there.
Yep. And we do provide the ER ratio on these, so you can see how well it is that we work with each of these different securities. So feel free to take a look at these. If you have any questions about this, feel free to also contact us at support@VPM Partners with any of your questions, and we'd be more than happy to be able to explain that, maybe if you have a specific question around each of these. But what this is designed to do is, you can see it's interactive. It gives you that drill down. So if we want to, we could pull up on the bond side of things, we could pull up the breakdown when it comes to bonds. And here's what we were talking about earlier as far as the movement within the bond space. So we had a 68% liquidation when it comes to of all the positions, we had a 68 percentage point move of the high yield bond funds. So chances are, if you have these within a portfolio, you also saw some considerable liquidation of those securities.
And that's what I was talking about as far as seeing that big move. And it's interesting that the high yield, there seems to be a lot of move away from that. And also, those of you, I know we have some of our old friends online here right now, and some new folks that have been invited to our show. And these transparencies really help you to determine some of the rotation and things that are going on, not only in our database but the markets, because this is a reflection. VPM actually responds to these changes. It doesn't predict them. So once we see these changes, we see trends breaking down, other things happening, then we're going to move to these elements.
Yeah, and just going a little bit further on this, you see again in the investment exposure, it's the same story where we're seeing this massive liquidation. If you look at our Global Equity 4 strategy, we had already sold out of our position in EFA and EEM a few weeks ago in July. And we're seeing the rest of the mutual funds follow suit in that same story, as they're getting out, doing the flight to capital for capital preservation, and we're seeing that safety play right now. If we also jump over to the weekly research, this is where we store a lot of the commonly viewed at ETFs, as well as some mutual funds in here. And again, you're seeing that same story that we saw over the entire database played out in these best of breed mutual funds and ETFs, where we're seeing the selling of the foreign large value as well as the foreign small and mid. If we scroll down here, we could see the positions that make up our global equity strategy. And here is, just as I was talking about going into today's open, we had the sell on the S&P small cap and the S&P mid cap 400. So, we exited those positions, and at this point, I believe in the Global Equity 4, we only have a 20% holding as of right now.
Which is, I think, SPY right now. Is the only
it's just SPY at this point. Yeah. So obviously, we are taking a more defensive stance for the time being, just waiting for the market to develop some trends of some sort, whether positive or negative.
Yeah, and I think that's exactly what's happening. The reason why we've broken that down, like Mitch was discussing, is that we actually have seen the small and mid cap segments of the market, or those asset classes, be under pressure. Most of the year they tried, mid cap did a little better. Small cap, I featured that on Friday, that chart had actually been able to make a new high, but then just completely collapsed, trading down and having a huge outside reversal pattern. And we talked about the S&P, we didn't get the reversal, but we did get it in the small caps. And the small caps led us up in 2013, and it's maybe leading us down in 2014. We'll see.
Yeah. Looking at the globe at a glance, I think probably the biggest news last week was the fact that we had the worst performer of the week was actually out of Germany. So although we had all this news and commentary out of the emerging market space, it was actually the Germany MSCI index here. Again, we're tracking all these different single country ETFs to represent these countries. That had the largest loss last month, with a loss of 4.88%, to bring it down year to date, just shy of 10%. And interestingly enough, it was South Korea that had the largest gain of last week. And I think it was around 1.25%, 1.5%. I'm just pulling that up here. That was actually 2%. There you go. So a gain of 2% on the week. So, there's certainly some significant geopolitical risk that's coming to play. As you can see last week, just about every country was down when you look at it on a weekly basis. So we're just switching the measure from year to date to, there we go, to to just looking at last week. So you can see just about everywhere across the globe there was red. So there was massive losses across the board for last week. Jumping back over to the 2.0 system, I thought it'd also be good to just point out the activity that we're seeing when it comes to the overall sectors. So again, if you click on research within the 2.0 system, we have these composites within the database where you can see how overall sectors and groups are. And we mentioned this in commentary. At this point, we've already sold off two sectors, consumer cyclical and capital goods. But going into today, we're also liquidating pretty much everything except for healthcare, services, as well as transportation. So again,
at least healthcare is kind of considered to be a defensive sector. But if you look at that on the screen there, healthcare is the only one that's positive. The other two are fairly new signals, 29 and 39 days that are not necessarily going up at the moment. They're down 1.5% and 0.9 as of Friday. So.
Yeah, and if this was like a strategy that you wanted to replicate within your own practice, we've talked about this before, but we have a large number of these pre-built Premier portfolios, and you can use something like the Premier Core Equity strategy. I think I have that loaded up on this one. I do. So here it is, the Premier Core Equity Sector ETF strategy. So this is a strategy built of 11 different ETFs. We had been long 8 of those positions. We had 4 orders today. So we're taking that move from 88% invested down to, we'll say 45% going into today's open, give or take a few basis points just for slippage when it comes to execution.
Yeah, and I want to say something because the only time that we've seen VPM go to 100% cash is back in the crisis situations, 2007, 2008, we saw it go there, and then also in 01, 02, we saw things go back, to very heavy cash. Typically speaking, we're probably in most of the cash, especially when you get to your individual stock strategies, you're looking at probably having most of the cash that you're going to have. Maybe there's a few more incremental things that are coming. The fact is there were some buys. I have a portfolio I've used for a long time. I actually had one buy and looked at it. It did okay, so we'll see how it plays out. But bottom line is it's not everything is going down right now. So.
Yeah, and yeah, I mean, we're still holding on to the position in SPY as I have the Global Equity 4 pulled up. And you see that we went from that current exposure of 60% down to 20% as of this morning's open. So we are still holding on to some positions. It doesn't mean that the entire market's falling apart, but we are certainly taking the defensive stance on a number of positions just because the trends have broken down on these.
And I want to point something out here, Mitch. I want to grab the whiteboard real quick because let's see if I can get this chart a little bigger. I'm going to close that real quick. I want to make this just a touch bigger here, just because this is, I think this is important to understand exactly what's going on here. And this is exactly what we're seeing from a database perspective and everything else that we're seeing. And now if I can get my whiteboard up like I was about to do. This is the equity graph here of the Global Equity 4, and this is always what happens here, by the way, is when you see sideways movement, if you look at these periods that's happened, and I've talked about this forever, and this is how VPM works, is when you start to get into periods of risk, 07 through 09, you notice that the arrows are flat. When you start to, you get up into 10, the uptrend had completed, and I can see part of, you can see just above where I'm sitting here, all of this stuff, and it just stair steps up. So in 2011 and into around 2000 and late second quarter, third quarter in 2012, we saw this market turn around and start to trend again. So this is the way VPM's always worked. during 2011 and 12, there was a tremendous amount of risk. So VPM will go into this sideways. I call it the EKG mode. It goes sideways. Now what we've got is we've got another sideways pattern setting up here as it's expanded. I think net over that period, we're up well over 30 some odd percent since the 2012 lows, even though there were some numbers that happened in the craziness in 2011 when Europe was causing us to swing 10 and 12 and 8% moves in about as many days. And it was really crazy volatility. We did see some risks that came in, and VPM was underperforming if you're matching against the S&P 500, but that's not the appropriate. When you start looking at the world indexes, it was pretty much in line with what was going on with world indexes. The S&P started and finished at the same price, basically, where if you look at the world indexes, they were down between 4 to 6% on even when you did a composite. But this is how what we're doing right now is adjusting the relative risk to volatility and to some of the other elements that are coming out. And that's exactly, this is a classic example of the stair step that VPM does. So you're going to have times, depending on if you want to track what it's doing from day to day, then maybe you can find a way to get frustrated. One of the things that you don't want to do in periods of time like this, there's a classic overthinking strategy, which is the art of creating problems that don't exist, or something like that. And that's exactly what, there are no problems here. You're not missing anything. Even if the indices were to spike up, there's still a ton of risk at these levels. And once again, VPM has stair-stepped the equity over time, and I don't have any of the percentages charts on here, but it's a pretty good number.
Well, one of the other things worth mentioning, think about what we were talking about back in 2011, 2012, when it came to the issues of the debt crisis out of Europe. And what are we talking about again now? We've just mentioned two countries that are having serious risk issues. Argentina, in the case where they actually missed a payment. Portugal, where there's some serious concerns when it comes to one of their most prominent banks within the country. And they're going back to the ECB to sort this thing out. Germany, one of the strongest members of the ECB up until right now. I mean, they're down 10% on the year, and we'll see how things continue to shake out when it comes to the overall European nations. But clearly,
I happened to run across a story on CNBC, and there's 11 countries that are at risk of default right now or missing payments, and our friends in Greece are still one of them. So they haven't talked about Greece. Portugal showed up again, and don't think that things are all rosy down there in south of Spain or whatever. And it's still very, very tough. And you're seeing, even in France, you're seeing a lot of risk show up. And obviously, as Mitch pointed out, Germany had the worst performance last week. So
yeah. And, one of the things to keep in mind is, we've been talking about all these issues for a long time. And that's been the trump card for all these perma-bears, like Hussman. That was the name you were thinking about, Bob.
Thank you. Yeah.
You look at his funds, and he's actually been significantly down since the bottom of the crash. He's actually been doing worse and worse since 2009. And the reason for that is because he's had that perma-bear attitude. And I think Bob and I would also say that we're reluctant bulls and reluctant bears at times, just because we have to go where the market takes us. Yes, there's still some significant fundamental issues, but for the time being, we saw it like last year, the all-weather ETF strategy kept right up in line with the market. Yeah. And even though there was all these fundamental issues that people have been talking about that have caused such a tremendous influx of advertising when it comes to the gold bugs out there, yes, those issues are still out there. They haven't been fully addressed, but for the time being, the market wasn't paying attention to it. But it looks like the market has been giving it attention again.
Well, we've been having so much fun. We got 12 minutes left in the show. So one of the things I want to make sure, let's talk about things that probably need to be done within this. I'm going to go back over to TradeStation here for a minute. One of the things I said I was going to mention, and I didn't, and I wanted to make sure I brought this up before the show disappeared on us. And here we are going to miss out showing the energy again, right? Here's the point of what I wanted to bring out to you is there were several events, and I don't know if I'm going to have it. I may actually have put it over here. I'm not sure. No, I did not. I thought I had it set up. But here's a monthly graph. So here are the dates of similar patterns that had unfolded last week at the end of the month. The last reversal of the type was on 7/31/07, which was prior. This was literally at the very first, around the first announcement that Bear Stearns had an issue, and people were criticizing me, and I said Bear Stearns is history, and it was. And the only thing brokerage firms have is their integrity. And when you miss, they didn't miss a payment on a hedge fund. It was not. That's not what happened. What happened was they were undercapitalized, and when they were undercapitalized, everybody realized that there were other issues, more systemic issues, and everything from all the mortgage holders countrywide that was playing, also banks and WAMU, and we know all the guilty parties of the time. But that was the first sign when that reversal happened on 7/31/07. The one before that, September 29th, 2000. And I don't know if I can get back to show some of these, but this is the pattern I've got on the page right now. I've got a cursor on it. But that was another reversal that happened, followed by a big decline. All of the declines on these points were 15% or more from these levels. In the case of '07, we saw a print, literally a print for a second in November of 2007, that it made a new high, and then it just failed. It was another one of those. It was almost like what we saw last week, where we were struggling to get through a price, and it just failed after it got up there. The other prices where it happened, 7/31/98. Those of you remember the 98 trade, that was a huge our small cap sell-off. Monster small caps were the villain in 98. Of course, that led us to the 99 dot-com boom, but that's a whole nother story for another time. Then the next one was on January 30th, 1981. That was the point where the market had also printed a new high. There was about a 17% decline. And then the last but not least that I went to, I didn't go back further than this, but it's on 131.77. And that was another top, and that led us into, there was a low in 1980. When I started in the business in '79, I think that daily, if we printed out 40 million shares, that was like a monster day. I remember we had like a 60 million share day one day, and everybody was completely overwhelmed with that activity. And of course now we do that in, I think, the first milliseconds of the trade of the day. Now we do billions of shares a day, and I think every company in America is actually listed on the New York Stock Exchange, unlike it used to be. It used to be a very selective group of folks. Now everybody's some way, somehow has got into the public markets, as we've gotten ourselves to be able to do that. But all of these numbers have been significant, and sometimes what has happened on a couple of these occasions, even though there was this big reversal, the markets were able to rally and print a very brief high, and then everybody, the market participants went, wait a minute, what are we doing? We can't buy these here. Massive sell-offs ensued after all of these events. And I didn't get back. I should have went one more time, see if there was anything around 70. 71 to 74 was another time. It was pretty bad. 66, being a market historian, there were some other elements out there. 66 was brutal because it was like a 4-year kind of bear market thing that just wouldn't go away. And but anyway, these are events, and I wanted to point out that what you do with these things, and if obviously a VPM user, you've got all that. Others that might be on the call today, there are other things that you need to look at. You need to scrutinize everything that you have from the standpoint of its validity and why you own things when situations happen like this. And the best way from our viewpoint is to do fundamental and then bring in some overlay with the technicals, utilizing a VPM type strategy so that you can actually make some decisions on how to raise some cash. Raising some cash, 3% off the highs of the move is probably a good thing. And so we're just, like I said, the whole scenario that we painted today really is that while the market's not in a collapse mode, it's not 2008, and it's not 2000, and it's not maybe even 2002 when we saw a big collapse then. The elements aren't there, but what is there is that there's a lot of protection being taken and a lot of, I guess, uncertainty coming in the marketplace that you're seeing a lot of selling. It's going to be interesting. Like this week, as I mentioned in commentary, it's going to be really key for the trend. If we're able to close lower, and especially if we take out that magic number, that 1916 number that we came so close to taking out in the little panic that was going on Friday intraday. If we take that out, then we're going to see this thing continue down and go down to some of these numbers we're talking about. So I would be looking really hard at any asset that you had very low confidence in. So maybe, Mitch, maybe we can do did you find an ETF we can look at from an energy standpoint, so it looks like?
Yeah, let's go ahead and pull up VDE.
What is it?
Victor David Edgar.
Okay.
And this is optimized on the 3.2 weekly.
I've got monthly up here, so let me get weekly.
And we saw a fresh sell on the security today after a 9% gain.
And which one? 3.2?
3.2.
Okay. Yeah, so we had pretty nice gain on that thing. You can see the exit long here on above Mitch's head there. We've owned this for a while, since February, I guess. I guess since February, right?
March 10th is when we got in.
Oh, there it is. Yeah, March 10th. You're right. So looked like February on my screen. So we've held that. What was the gain on that?
9.36% as of Friday's close. So I'm not sure what it opened at today.
It opened at 137.54. So it's actually up a little bit.
Up more, yeah.
So the bottom line is this index is breaking down. It's not unlike if we brought up what's the Russell symbol? Do we know? I'm just going to bring up IJR. That'll get a small cap anyway. But you can see this index has been down for a while here, and in fact there is a objective here for it to go down to where's it at here? The low target is 100 to 97, and we're currently at 105. So that's about another 5 or 6% on the small cap index as far as the Fibonacci price projection tool is doing that right, is suggesting that right now. So yeah, so the whole theme. Do you have a favorite energy stock that you wanted to bring up? And we got last thing.
Last thing.
So your last
let's go ahead and pull up ExxonMobil. They were one of many that had earnings last week, and it was interesting is while they did have they did beat their estimates, because their production fell, that caused it to be a negative for the stock right after the earnings was released, and that was probably the consistent theme on a lot of these big oil producers.
Yeah, and a lot of these stocks, folks, just because of the overall sentiment in the markets, you can see that it looks very similar to the action where we just saw a collapse down to, it's traded down to the 40-period moving average. If you notice that I don't think you can see it because it's behind me, but the PPM4 is at 0.277, which is trend mode. If you look at what that value is there, you're looking at that 40-period moving average is 98. We're trading just above it at 99, and the low of the day is 98.31. So we basically are holding that 40-period moving average. Right now there's a 60% probability that it will stabilize along this line. And what will happen is maybe we get sideways movement here for a week or two. The momentum will continue to bleed off. It looks like all three of the PPMs, Mitch is kind of in the way there, but all three of them are fading from the standpoint of all that. So with 1 minute to go, scrutinize your assets. If anything weird happens in the next couple of days, we'll announce by late tomorrow that we're going to do something on Wednesday just to cover the markets. And as we did last week, after the big decline, we even did the end of the day. We did about a 20-minute session. So the nice thing is we have this venue that we can get this information out to you when it happens, and we can respond to different elements that are going on. And if you don't have time to watch it live, like many of you are now, then you can always stream it later. We had quite a bit of activity even on the streaming after the fact, and continuing into this morning. So anyway, folks, have a great day. Looks like I said, look for a last hour sell-off as long as we stay below, looks like 1930.80. If we get above that, we may firm up a little more. But for the most part, we should finish. And it's 10 o'clock. Our time's out. Unless Mitch has got one last word. And
not today.
Yeah, see, there you go. All right, folks, have a great day. And we will see you on Friday for sure. And possibly we'll come back. And these are the summertime show hours. Normally we do these Monday, Wednesday, and Friday. And then we do Process Warriors, which is about software and portfolio construction. Anyway, have a great day. We'll talk to you on Friday.